Hello and welcome back to another video. In today's video, I'm going to show you why day traders and day trading algorithms can fail and what to do to avoid it. I'm going to give you some real examples, so hopefully I'm going to make things as clear as possible. And it's not just applicable to algorithmic trades, it applies to anybody who wants to trade very short term. So somebody who wants to hold trades minutes or hours rather than days or weeks. There's many reasons that traders fail, like risking too much, having a strategy that's got no proven edge, or maybe having no strategy or plan in place at all. But the reason for failure that I'm going to talk about today is the lack of time in the trade. Because although there are consistent edges, meaning you're going to make money in the long term if you keep taking the same sort of trade, there are consistent edges to be had in short-term trades. Sometimes those edges just aren't big enough to cover trading costs, unlike if you were holding trades for like days or weeks. I'm not saying that you can't find edges in shorter term trades, it's just harder. Actually, in fact, hang around to the end of the video and I'll link a video and a report that I've done where you can get a strategy that's a day trading strategy. Trades do last less than a day. It's actually a really good one. It's got an edge that is actually big enough that does cover trading costs. So end of the video, you'll find that one. I'm going to show you two separate strategies with their backtest reports. The first one is a day trading strategy with trades lasting 10 hours. And the second one is a longer term strategy with trades lasting about 45 hours, spanning over about 3 trading sessions. I'm going to show you the equity curves and the net profit for both strategies over a period of about 12 years that will run the backtest. And then you can decide which strategy you'd rather trade. So we'll go over to the charts now and I'll point out the avoidable mistakes. The first strategy that I'm going to show you is the strategy that lasts 10 hours. So it's a day trade strategy. So it's just a short strategy. The strategy is not important. What is important is the numbers that I'm going to show you and show you in comparison to the other longer term strategy. So looking on the screen, we can see this strategy trades last 10 hours, like I say, and it trades every single day. So we've got a trade every day here over the 12-year backtesting period. So let's just have a look at the performance report. That's the equity curve showing the results of this strategy. And yeah, it's all right. It's going in the right direction. Like I say, the strategy is not important in this video. Let's have a look at how much money it made overall. Net profit of $108,000 over the 12 years, so pretty good. So look at the total trade analysis a minute. The number of trades got 3,108, so that's one a day for that 12-year period. Okay, so they're the numbers that I want you to think about at the moment, the amount of trades and the net profit. Let's have a look at the next strategy. Now, as we can see, we've got less trades on the charts. You can see we got trades lasting 45 hours over 3 different trading sessions. So let's again look at the performance report. There's the equity curve. Again, it's certainly going in the right direction. Not great, but it's it's going in the right direction. Let's have a look at the net profit. Now, a net profit of only 67,000. Before, remember, we had one at 108,000. This has only got 67,000. Probably because we've got less trades. Let's have a look. Yeah, look, we've only got 618 trades. So going by those statistics, which of these strategies would you rather trade? Would you rather be taking the trade every day and make that 108,000, or would you rather trade more like once a week and take the 67,000? Well, don't answer yet, because here's where this avoidable mistake comes in, because in my backtest report here, I haven't actually added in any trading costs like I talked about earlier. So what we do now is we'll add some trading costs in. Now what I'm going to do is I'm going to add $15 per trade, which is actually going to be equivalent to $30 once you've come out of the trade. So it's 15 in, 15 out, and so it's totals to $30 per trade. Now that's equivalent to 3 pips. This is pound dollar, and I'm trading 100,000 units, which is equivalent to $10 per pip. So $30 is equivalent to 3 pips, which by the time you've paid commissions, you've got the spread, you can be exposed to a bit of slippage, you could quite easily it could be costing you 3 pips per every trade you did in and out. So let's add them in now and see how the results change. We could do this up here, put in $15 per trade. Recheck the strategy performance report and notice that still the same amount of trades, 3,108. And now look at the net profit. The net profit's gone down to 14,000. Now that's a massive jump from the original 108,000 down to 14,000. What a huge impact the trading costs has had. Let's have a look at the equity curve. Look at the equity curve. Suddenly we went from that uptrending curve moving in the right direction to something that looks pretty horrible and something that you probably certainly wouldn't trade looking at that. Okay, let's do the same and add the trading costs to the other strategy, the one that's in the market for longer. $15 again. Let's check the report. Now, equity curve looks almost similar to what it was before. Not too bad. Still moving in the right direction. Certainly a lot better than that one of the shorter term strategy. Let's have a look at the net profit. Remember before, it was 67,000 and it's dropped a bit now. It's down to 48,000, but not a huge drop, not like that short-term trading strategy. So now let me ask you, which one would you rather trade? Now you've actually seen a decent reflection of what the trading costs, how they impact the strategy. I think you'll agree with me that you'd want to trade the longer term strategy. And I'm showing you this demonstration because these are things that are quite often overlooked when backtesting a strategy, especially when you're using software and you're not actually putting in the right numbers, putting in slippage commissions. And it's not until you start trading in real life and start analysing your report from your broker that you realise how much these trading costs do have an impact. It's a bit of a generalisation, but having a trading strategy that has a longer trade duration, like the second example, tends to give us bigger trades. We trade less frequently, but we have larger trades, and larger trades allow us to overcome the trading costs and sometimes at the end of the day make more money, as we've seen in this example. Being in trades longer just allows us to catch a bigger move because, as Larry Williams says, trend is a function of time. So the longer you're in a trade, the bigger the move or the bigger the trend is available for you to catch. And that's about it for this video. Like I said earlier, if you do want a trading strategy that's got an edge big enough to overcome trading costs, I've done a video on it and I'll link that. But don't forget to download the PDF because that's got some all-important modifications or improvements to that strategy that gives us an even bigger edge and after trading costs allows us to make more profit. So I hope you've liked that video. I hope I've made it clear. If anything is unclear, then you can leave it in the comments below and I'll get back to you or maybe make a follow-on video. And you can email me, jared@thetransparenttrader.com. Go and visit the website. There's always some good information there, strategies to download. And please give the video a like if you did and subscribe to the channel if you haven't already. So until the next video, this is Jared Goodwin and thank you.